U.S. natural gas futures slipped below $2.80, nearing their lowest level since November 2024, as near-record production and ample storage continue to weigh on the market. Output in the lower 48 has averaged 108.1 billion cubic feet per day so far in August, edging above July's all-time high of 107.9 billion cubic feet per day. Even with hotter-than-normal conditions this summer, strong supply has supported above-average injections, leaving inventories about 7% above seasonal norms and still building. Weather remains the key driver, but recent forecasts offer little help for bulls. The longer-range 8 to 15-day outlook trends even cooler, showing the ridge weakening and shifting south. With cooling degree days tracking near or below average, the setup points to subdued late summer demand rather than a last-minute surge. Meanwhile, with the heat starting to fade and even turning cooler in some regions, storage injection should once again come in stronger than normal after that brief slowdown during August's hot spell. That likely pushes the storage surplus back toward 200 billion cubic feet, a pretty bearish setup for gas prices, especially with the low demand period right around the corner. Nevertheless, I think the bearish pressure is finally starting to run its course. Prices have already fallen into oversold territory and are now much more in line with fair value and futures expectations. What's even more important is that traders are beginning to look beyond the current weakness and shift their focus toward November, when the high demand season kicks off. That timing also lines up with a likely increase in LNG export volumes in late November or December. Put together, these factors suggest the market sentiment should gradually pivot from bearish to bullish as we move closer to winter. From a technical perspective, we just saw another dead cat bounce. Prices tried to claw their way past the $2.95 resistance, but instead the cat smacked right into it and landed flat on the $2.75 support. Nevertheless, there is a solid support zone just below, extending down toward the strong $2.50 level. That should help limit the bearish momentum and increase the chances of a rebound in the near term. The resistance is locked in at the short-term pivot near $2.90 and the minor swing high at $3. It would take a decisive break above those levels to shift momentum back to the bullish side, which could then open the door toward $3.15. Nevertheless, without a fresh catalyst such as a burst of late-season heat, a jump in LNG demand, or storm-related supply disruptions, the path of least resistance points lower, with traders eyeing a test of those deeper support zones. Don't forget to like, drop a comment and check out the previous video to help support the channel, and see you in the next one.